Since June 26, 10-year bond yields rose from 0.25% to 0.47% as of late, thereby reaching levels that had last been seen at the end of January. The trigger was a speech by ECB President Draghi on the euro area outlook. He concluded that the recovery was strengthening and broadening. Most noteworthy, he became surprisingly confident on inflation, stating that deflationary forces have been replaced by reflationary ones. At the press conference following the June meeting, the tone on inflation still sounded less confident. Consequently, the yield increase was accompanied by an upward move of the 10-year inflation expectations priced by markets. Looking ahead, we think that the latest rise in yields is well-founded. Underlying inflation has already shown signs of strengthening and will continue to do so, thereby confirming current market sentiment. With domestically driven growth remaining solid, a less accommodative monetary policy by central banks is warranted. We continue to expect that the ECB announces in September that it will start to taper its monthly asset purchases in January. That said, the ECB will still support government bond markets by means of monthly purchases for the time being, and net issuance will be tight. We therefore do not expect government bond yields to go through the roof, but rather look for a 10-year bond yield level of 0.6% towards year-end. Political risks are still with us. Looking ahead, we see two major risks. First, in the US, President Trump is under pressure for various reasons, e.g. Russiagate. Also, he still has problems to pass his healthcare reform. This raises the risk that the much-awaited tax reform turns out only a disappointing one. Second, there will be general elections in Italy early next year, and it may well be that Eurosceptic parties get a majority. Moreover, non-performing loans and weakness in the banking sector remain a cause of concern. That said, markets have learned to live with political uncertainties. Uncertainties failed to drag on business confidence given sound macroeconomic fundamentals. Moreover, the Frexit risk morphed into a macromania. We expect France's popular president to initiate a series of reforms that will ultimately increase potential growth. All in all, we feel confident that markets will not lastingly be negatively affected by political risks in the months to come. Indeed, equities did quite well in the first half of the year. Notwithstanding some weakness as of late, since the start of the year, share prices advanced by roughly 8% in the euro area and in the US. Looking ahead, however, we remain constructive on equities for the following reasons. We expect a solid macro environment to persist on both sides of the Atlantic. It will contribute to a healthy earnings growth. Costs of capital are still low. For instance, in the euro area, the real non-financial iBoxx yield is still in negative territory and will stay there for the time being. From a valuation perspective, mainly US equities appear dear, while euro area and Japanese equities are not far from their long-term average. Unlike to the euro area, the S&P 500 is currently running well above what one would expect from earnings. Against this backdrop, we look for an increased rotation into equities as currently the fund's balance of cash is above the historical average. All in, we remain constructive on equities. We maintain our call to overweight euro area over US stocks. Political risks and volatility in bond markets may trigger temporary setbacks. However, in our view, this would be a buying opportunity. Thanks for listening. We'll keep you posted.